Hey guys, Mike here. So obviously big day coming up in this week. We have earnings, which I went over in yesterday's video. They're going to start rolling in by the bundle every week now, okay? And I swear like the last 4 earnings seasons have been just like the biggest ever, but this will be the first one where you see the market is actually really revving up now, right? And all the bulls are coming out. And so will this earnings season support it, or for the bear case, this is what they say is going to finally give us the last leg down in the bear market. We're sitting right there on that descending trend line moving up to see if we can break it. And so we're going to go into the charts to see which scenario is going to play out. It's funny, the S&P has one scenario, the NASDAQ has the total opposite scenario. And then most importantly, when it comes to earnings, the expectations I'm going to show you, and you might be really surprised because they're going to have a real effect on how the market reacts to them. That's the big thing. But you can see right here a total flip in 2023, right, of what's happening. Just real quick, market's at 4.5% in 7 days, right? But more importantly, look at what's getting the attention now. You're looking at consumer discretionary, tech, materials. That's because of China opening, up huge. And then real estate, which that one actually kind of surprised me, up big versus what was people buying into all of last year, especially the end of last year. Utilities, financials, energy, those are actually at the bottom now. So it's been this 180. You've seen this going on with BTC and the other altcoins as well. A lot of risk. And looking at the chart, you can see on the S&P, a lot of people talk about this, right? Is this inverse head and shoulders that is forming on the S&P to see if it actually is going to play out this week or not. And, this ain't drawn perfectly because of the marker I'm using, but you get the point here, right? And so you got an inverse head and shoulders on the S&P. But if you look at the NASDAQ, a lot of people are saying, well, hey, wait a minute, that's got an inverse head and shoulders, which means can be bullish, right? Well, what about the NASDAQ, which has a head and shoulders? Some people say this is a head and shoulders that's playing out, and that's the right shoulder right there. They could be playing out this week as well. And so it's just funny when you look at it, and you can see what you want to see on here. And none of these are 100%. They don't always play out, that's for sure. Or there'd be a lot more billionaires on the planet, right, if they did. And then you got the VIX. Lord have mercy, look at this thing right here. Sitting in this range once again, where it has bounced. When it's been in this range, the market has sold off because the VIX has spiked, right? On top, of course, when the VIX is high, the market ends up ramping up and going up. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. And so the big question is, which one will play out on which index, of course, and then will the VIX finally wake up or continue to head down to like the 16-ish area, which I don't think we've seen it in that area for quite some time, actually. And so a lot of people say it has to do with options and everything else, but or lack of hedging and stuff, and we're just comfortable, which is, of course, what I showed with the fear and greed, right? When people get greedy, that means we're getting very comfortable with things, and so maybe a lot less people are hedging, excuse me. But that leads us into, obviously, what's going to drive the market now is earnings, right? Because we know inflation has been coming down. We got the Fed meeting on February 1st, of course. But until that happens, then, of course, that's when they're going to do either a rate hike or no rate hike. Some people are calling for a pause. Some people are calling for 25 basis points. Some people are calling for 50, which there's no way they're going to do 50 in my opinion. But I would say 25. But more importantly, what's going to drive us for the next 2 weeks is going to be earnings. And there's some pretty big ones coming up, right? And so this right here is what we got to look forward to. And there's one line here is what I want to pay attention to. This is what we're here for, right? Earnings for the S&P 500 companies are expected to be around 4% lower than they were in the fourth quarter of 2021. You have other services that say between 0 and negative 7%. So no growth, right, on earnings compared to a year ago. And when you look at this right here, this is the sector level change in Q4 2020 EPS. This is what they're estimating, okay? And you can see with energy and utility, they still expect positive growth. Everything else is negative, especially when you get down to consumer services, consumer discretionary, IT, healthcare, and then the S&P 500, financials, real estate, all that good stuff. So everything else is supposed to be negative, right, on the EPS. Then you go to the earnings growth. And if we pay attention to the bottom down here, you'll get the bars. These represent the same thing. But I want you to look at Q3, which is the very bottom, September 30th is what they had as far as what they thought earnings growth would be versus today, what they got it at. And you can see when energy, industrials, real estate, utilities, not a really big change, right? Not a real big change. Then you get the S&P 500, and all of a sudden you went from 3.5% they're expecting September 30th to negative 4.1%. Healthcare falls off a cliff. Information technology goes from -1 to -9.5. You get to communication services, -6.8 to -19. Consumer discretionary, -7.1 to -20.3. And then materials, this is what they were estimating, okay? And so, of course, what are you seeing there, right? The bar. Once again, where's it going? It's on the floor. The expectations are hugely low at this point in time, right? And so I've read some reports even saying, like, if these companies miss these earnings forecasts, then something is really wrong with them. And they may pay the price. But the real expectation is that some people, they may miss, like say they miss top line, but they hit bottom line because now all of a sudden they're getting to keep more money because now the dollar is weaker and all these cuts they've been making, all the layoffs, things like that. And so they may make bottom line. And so how's the market going to react for a slight miss? You know, back in the day, you might get hammered for that. But now they're like, oh, okay, well, the bar is low. We're not expecting much out of you, you know, right? And so that's why it's important to know that stuff. So the expectation is really low, which makes it even easier for them to skate on through. That doesn't mean the market's going to move up greatly, but also don't mean the market's going to move down, right? Because of where the expectations are at. They're more in line now. Remember, we went through second and third quarter, they hadn't really lowered the expectations that much. You saw that right there on September 30th, and I'm showing you. And so companies were getting hammered because they were missing by a country mile, some of them. But then we moved, you know, up into the third quarter earnings, and now we're moving to these earnings, and also the expectations will come down to be more realistic. And they're like, okay, maybe it's not so bad, right? Maybe it's not so bad, you know. And I think I saw this right here. It came through, somebody sent me this, and I want to show this to you so we keep things in context, right, of what we're going into. Because a lot of people, you know, have only been in the market since like 2010 on, or even 2020 on, right? So they don't really know when we're talking about these rates and everything and the difference in the markets we're facing right now, right? Everybody's talking about going on this massive bull run we're going to go on. And if you look at this really keeps things in perspective, okay? And let me know what you think down in the comments. But when you see this right here, this looks at 2009 to 2021, right? The massive bull run, and then today's market going into 2023, right? And so if you look at this, it's broken down like Fed behavior, right? Highly stimulative in 2009 and 2021. Remember, they were the biggest buyer of bonds, mortgage-backed securities, and all that good stuff. Now they're tightening like crazy, right? Inflation, never even heard of inflation. Now all of a sudden, boom, 40-year high, okay? Economic outlook, positive. Now all of a sudden, everybody thinks there's going to be a recession, okay? Likelihood of distress, minimal, because everybody was getting free money, basically. It didn't matter if you had a poach, you got a loan and stuff, right? Now those risks are rising. Then you look at buyers. Buyers, man, everybody was just piling in the market during those years, right? Couldn't lose. Now all of a sudden they're like, ooh, I don't know. Pretty dang hesitant, right? Key worry. FOMO was back then. Now it's investment and losses, okay? Then you got risk aversion. Absent during those years for sure from 2009, 2021, and now that's rising. And I'm going to touch a little more base on that in just a minute, right? Financing. This is the big one for me when it comes to publicly traded companies. Plentiful. Get a loan any way you want to, you know, issue stock, whatever. Now it's scarce. People are like, okay, because people are much more at risk of going bankrupt in an environment like this than they were then. Interest rates, obviously lowest ever in 2009, 2021, and now they're more normal, or what some people don't know that, but this actually is normal. Now, prospective returns. You look at this, it says lowest ever, 2009 and 2021. We're going to talk about this. This isn't stock market returns. And then more than ample now. And this is that X factor too, that I don't know how the market is going to accept this or how it's going to work out because, again, you only have so much money, right? One piece of the pie, right? Well, where has it been from 2009 to 2021? It has been in stocks, right? Stocks, crypto, stuff like that. Because why? You couldn't, I mean, who's going to put it in a CD, a savings account, a money market account, bonds, all that stuff. Now all of a sudden, you're looking over here and you're like, wow, we can actually pull a decent return with no risk almost, right? And be good to go, like for the first time in years, okay? And so that's something where people are like, oh, how about this? And so are more people going to start going towards that, especially smart, what they call smart money. People got a lot of money going towards that. I know Tiger 21, who's made up all those billionaires, they talked about this, like where they're putting their money and stuff. And that's one thing. They're like, wow, you know, because when you can put $1 million into bonds or, you know, anything pulling 4 or 5%, when you got $1 million, $2 million, $3 million, you're making some money. Okay, you put $100 in there, you might not notice it, but they can notice it, and it's basically risk free for them. They're like, that's cool, right? And plus they're, you know, a little older, so yeah. And so if that money's going there, where is it not going? Not going in the stock market, not going in the crypto market, right? And so that's something to keep in mind. Again, we have to see how that plays out because it's just been so long before this option has really been there to really attract people, even people that have never even been in bonds before, like talking about bonds now, right? Like, oh, look at that. I pull 3, 5, 6, or whatever it is and do that. Yeah. Sometimes they're going to do that. And so, that's something to keep in mind as well. We'll see how it works. And the last thing I want to touch on is this right here. Everything going on this week, and we do have a lot going on, but check this out. Look how many Fed speakers are coming out. 1, 2, 3, 4, 5, 6 of them being rolled out this week. Now, I wonder what they got to say. Could it be dovish or hawkish? I'm not sure. But anyway, the real economic data that could obviously affect the markets are going to be Wednesday, obviously core PPI, core retail sales, that stuff. And then also that day, you're going to have business inventories, which we had a problem with. NAHB housing market index, a lot on the housing this week, right? Then Thursday, you're getting the Philly Fed manufacturing index, unemployment claims, building permits, housing starts. And then Friday, existing home sales. So a lot to do with housing. We'll see how that goes. Those stocks have been just absolutely on a tear. And so a lot of stuff about housing, but I think it's core PPI and sales and inventories people are going to be paying a lot of attention to, especially with earnings here now. And so I think that's going to start being put under a bigger microscope because, as you've seen, I've told you before, it's been a huge problem with inventories, even from the most well-run companies. I don't care if it's Nike, Walmart, Target, you name it. Lululemon's another one. Big problem with inventories, which means they're going to have to discount the stuff. And so that can definitely affect earnings, but we'll have to see on that one. So, and just let me know down in the comments what you think all those Fed presidents going to be saying. They're going to be dovish or what, hawkish? What you think? I mean, I just can't imagine. There's nothing good they're going to say. But at this point in time, the other thing is the market even going to react to them because they were out there last week too, right? Talking hawkish. The market said whatever. The bond market said whatever. You're cutting. We're good, and so that's where we're at, guys. We'll see what happens tomorrow. Let me know down in the comments as well. What do you think is going to happen? You think the inverse head and shoulders is going to work out in the S&P, or the head and shoulders on the NASDAQ? Like, where are we going? You think we're finally going to break through and out of this descending channel for once and for all, or are we just going to keep heading down? So anyway, hope you guys have a good one. Hit the like and subscribe button if you get anything out of it. I really do appreciate all your support, and I'll see you tomorrow.